Welcome back to part 2. Let's continue on. So in this segment, we'll start with operating returns, which are measures of the returns that come back to investors after they have invested in the company. Right? This is how investors assess how their investment has done. So we're going to talk about return on equity, return on assets, and return on invested capital. Right, the first one is return on equity, which is just going to be the net income that the company has. So this is what the shareholders, the current amount that shareholders have can lay claim to, right? The amount that they could be paid out of, and we compare that to the book value of equity, right? So how much money went in versus how much is currently coming out or is coming out for the current period. What fraction of book value of equity has been produced in terms of net income? Okay, so this is one. We can also look at net income as a function of assets, right? Here, we only include net income by itself relative to equity, but in return on assets, we add back the interest expense because when we look at total assets, we are including debt. In order to have the debt to be part of those assets, we had to pay the interest expense. So this is returned to investors. The investors have a claim to net income. Right, the shareholders have a claim to net income, and the bondholders have a claim to the interest. So we want to add that back to get a complete picture of what our ROA is. Right. So this will tell us what money was returned to investors or available to be returned to investors as a function of total assets. Right. So what percentage of the company, based on its size and assets, could we return to investors? Right, so that's what these ratios are designed to do. They're designed to tell us what is the return we have on our investment. Now, both of those two are sensitive to things. ROE is sensitive to leverage. Right, so we go back up to here. Debt is not included in this, but if I use a lot of debt to create a lot of assets, that's not going to affect the book value of equity, but it should drive net income up. So I can artificially increase my ROE just by having more debt generally, right? And the total assets that we have, right, is sensitive to the working capital that the firm has. Right, so both ROE and ROA have sensitivities to things that are not necessarily things that we want. ROE, the sensitivity to leverage says that it's kind of at manager's discretion. They can kind of pick an ROE target that they want and then get the leverage level to match. Right? Or in the case of ROA, it can be skewed by working capital, and so ROA still might not be a very good measure. So to add to both of those, we have return on invested capital, which should be relatively free from sensitivities to other things, but is much more complicated in terms of the calculation. It also doesn't have an awesome, straightforward interpretation that's very intuitive. Right? The general idea is that it's the after-tax profit that's generated from the business or the pieces of the business that are actively trying to generate earnings. Okay, so we've got earnings before interest and taxes. We'll take out the taxes. So anytime we multiply by 1 minus the tax rate, that's the same as subtracting out the taxes that we'd have to pay. So this is the after-tax revenue that we would have if we added back interest. Right, and then book value of equity plus net debt, right, debt net of whatever cash we have laying around, is going to essentially be the assets that we have on hand that we're trying to generate earnings with. So this is the return on the capital that has been put to use, the invested capital, things that have been invested in. Right, so capital that's been deployed towards projects and property, plant, and equipment, etc., etc. Right, how much are we generating in terms of after-tax earnings? Like I said, it doesn't have a great clear-cut intuitive interpretation, but the idea is the same. Based on what we had available, how much are we generating, right? So the denominator is how much we have available in terms of production capacity to invest in different projects or property, plant, equipment, etc. How much were we able to generate that could be returned to investors? Right? That's generally the sense for all these things. We're trying to get a sense of what the return to investors is. Now we can look at global corporation and see what their ability to use the assets effectively. right, by looking at ROA. Right, so we need these numbers. In 2016, we had ROA of 5.7%. In 2015, we had ROA of 5.7. And so this suggests that ROA went up, right? And we were able to use the assets at hand. Global was able to use its assets better to more effectively produce earnings. And so the return to investors was higher in 2016 than it was in 2015. Now, if you remember earlier in the notes, we said that its times interest earned had gone down. That seemed like a warning sign, but this is a good thing, right? And we said the times interest earned might have declined because they borrowed a lot of money, so we'd have a new interest expense. And it seems like Global is actually using its assets more efficiently than it was before because the ROA is higher, so whatever we invested in might actually have been a great choice, right? ROA is going up, so we think that in the future, the other numbers that temporarily declined because we have this additional borrowing will go back towards better levels in the future because we've made a good investment here. At least that's what it looks like, right? I don't know for certain. That's why it's an art form instead of a science. Now, the last thing that we learn about in terms of financial statement analysis is the Dupont identity, so named after the company Dupont. Which was EI Dupont de Nemours, or whatever, a French name that is now part of Dow DuPont. This technique was pioneered at DuPont itself. Right? The idea is ROE is a function of a lot of things. It looks like just net income and total equity, but net income is a function of many other things, and total equity can be a function of other pieces. So what DuPont did was they expanded ROE by multiplying both sides by 1 twice, so they could have a more intuitive version of how ROE works. Right, now you might be thinking, if I multiply both sides by 1, nothing changes. And you're right. But if you multiply by 1 correctly, it allows you to rearrange terms that might give you something that's more intuitive to look at. Right, so in all cases, we'll be multiplying both sides by 1, but on the left-hand side, where we have ROE, we will just be multiplying by the scalar 1, so just the number 1. But on the right-hand side, we're going to be dividing by fractions where the numerator and the denominator are the same, so the value is 1, but then we will rearrange terms so these things have meaning. Right? If you ever did in mathematics where you had a couple of fractions where so pretend there's another fraction right here on the right hand side of this one. If we had net income on the bottom, you could cross net income out here and net income out there where you consolidate terms. We're just going to be doing the opposite. Right? We're going to be bringing terms back by multiplying by 1. So here's what I mean. Right? DuPont said, let's multiply by sales over sales. This figure should be 1. But we can have net income over sales, which is a different ratio than ROE, and then we have sales over total equity. Okay, so this is a other ratio that we'll recognize in a moment, and this one's not, but we can do something else with this one which will help. So we multiply by sales over sales, which is 1, and now we'll multiply this result here by 1 again. In this case, we'll be multiplying by total assets over total assets. Right, and then we'll move terms around again, right? So we'll put this total assets under sales, and we'll put total assets over total equity. The reason we want to do this is because this gives us profit margin, this gives us total asset turnover, and this gives us the equity multiplier. Right, so where before ROE was just a function of net income and total equity, now it's a function of 3 other ratios. And so we can try and raise ROE by fixing, or raising, I guess, any of the 3 components, right? We no longer have to try and think about how we raise net income or how we raise total equity, or I'm sorry, lower total equity, right? This way we can see what's going to be an actual improvement in the firm that will raise ROE, right? Profit margin, asset turnover, and equity multiplier. Right. Here, if we can raise net income relative to sales, so we get to be more efficient in terms of our profit margin, ROE will go up. That makes sense from an intuitive standpoint, right? At least it should. If our profit margins get better, the company should be able to return more value to shareholders, right? Same with asset turnover. If we can take the existing assets and generate more in terms of sales, right? This value will rise, and so ROE should also rise. Right now, there is some trickiness here, because as sales rises here, sales will also rise here. So one of the assumptions is if we improve asset turnover, the profit margin stays the same, right? So if sales rises along with sales here, because it's sales figures both cases, then net income must rise to match the increase in sales so that profit margin remains unchanged, right? That's going to be the assumption here. Right, so I can improve profit margin, everything else stays the same, or I can improve asset turnover and the other two pieces stay the same, etc., etc. The one thing we don't really want companies to do to raise ROE is raise the equity multiplier, because all they're really doing is taking out more debt. So the company's not actually getting any better, but the ROE looks better, which may not be the best way of looking at the firm. Right? So when we talk about ROE and improvements, typically we want to talk about improving profit margin or asset turnover. And typically we can't do both, right? It's hard to increase margins and increase sales, right, or the asset turnover. Think about if Apple were to raise the price of an iPhone to increase the profit margin, it's likely that sales would decline as a result, right? It's not likely that sales would increase, right? So typically there's a trade-off between margin and turnover. Anyways, there's an example in here. So we've got Walmart and Nordstrom Rack, or Nordstrom, which is an upper-end clothing company, and Walmart also sells clothing. So we can look at these things and we see we've been given the pieces. We just multiply them together directly, right? And we see that the ROE for Walmart is 22.4% and the ROE for Nordstrom is 38.4%. So Nordstrom has a better ROE than Walmart does. Right. But this is generally due to the higher profit margin. They do have some more leverage, but it's mostly due to this higher profit margin. So we can say that Nordstrom's a higher profit margin company than Walmart is, which most people would accept if you know anything about Nordstrom. They are a higher end clothing sales company relative to Walmart. But the other thing we can do is we can look at Walmart and say, what would we need to change either the profit margin to or the asset turnover to in order to raise ROE to be as high as Nordstrom's, right? So in which dimension and by how much would Walmart have to improve to have the same kind of returns that Nordstrom offers? Right, so in this case, we can solve for the profit margin Walmart would have to have. And in this case, in order for Walmart to match Nordstrom's ROE, they'd have to raise their profit margin to 6.2%. This number would have to be 6.2 for the ROE of Walmart to be the same as the ROE of Nordstrom. Right? And all we did was we took, and instead of saying 3.6 for the profit margin, we put profit margin back in and said that the ROE had to be 38.4%. So we have 38.4% equals profit margin times 2.3 times 2.7, right? And then we solve for profit margin, which is 6.2. Okay, so we can do that to see what change Walmart would need to make to raise its margin to match that of Nordstrom. Okay. The end of these notes have a key summary of key financial ratios. So if you're looking for most of these things all in one place, there are a few missing from here, but not too many. So this is a great place to start if you're looking for financial ratios. So if you have to do it for, say, an assignment, this is a great place to look. They're summarized over the course of 7 slides. There is a little bit here about financial reporting, but we don't do too much with this in class anymore. Financial abuses do happen, even though we have safeguards. Enron's a great example of the fraud. This is something we try and prevent because when we do outright fraud, typically shareholders are the one that suffer. It erodes confidence in the financial system and makes it harder for firms to access capital. Okay. To combat fraud, we have things like Sarbanes-Oxley, and it had some specific goals. Most recently, we had the Dodd-Frank Act after the crash in 2008 that was aimed at trying to mitigate some of the issues that arose. The big thing that's an issue with regulation is that it's always targeted at the last crisis and not so much at what the next crisis is. So it prevents us from making the same mistakes twice, but it doesn't help us from making new mistakes. Right? So that is one big drawback to regulation. It also tends to be costly and sometimes places undue burden on small firms. These things are in the notes. You can go ahead and look through them on your own. If you have any questions, please post them to Plato, the Ask the Instructor forum. Thanks for tuning in. I'll see everyone next time.